Hi, everyone. My name is Mike DeBliss. I'll be presenting today on how the IRS reconstructs income in tax fraud cases. I am a partner in the firm of DeBliss Law. I practice in Bloomfield, New Jersey. I've done a few of these presentations in the past, and I certainly encourage anyone who has a question to reach out for me via email. I'll provide you with my contact information at the end of the presentation. But I am a tax attorney that specializes in issues like the one I'm presenting today, as well as foreign bank accounts and foreign asset reporting. So again, if you have any questions, feel free to reach out to me. My door is always open. So what I want to do to back us into this topic of how the IRS reconstructs income in tax fraud cases is just give you some background information on tax evasion and the crime of tax evasion. Essentially, in any criminal case where the government charges someone with tax evasion, it has to prove each element of the offense beyond a reasonable doubt, no different than any other criminal statute. There are certain elements that have to be proven, and each element has to be proven beyond a reasonable doubt. For tax evasion, there are three elements, and those are the three you see here. The first is substantial tax deficiency. The second is an affirmative attempt to evade the tax. And the third is willfulness, a very elusive term that we're going to dig into a little bit. So what I'm going to do is give you an overview of each of these elements, and then we'll be delving into the different modes of reconstructing income. Beginning with substantial tax deficiency, substantial is a very vague and general term, but not unlike other terms in the legal arena, it has a very specific definition, although the definition itself is very broad and very vague and is open to a lot of interpretation. So this term substantial has been an issue that has been litigated time and time again in federal courts. And this is kind of where we're left with, this is what we're left with today in 2017. It's considered to be a fact-specific inquiry that's left up to the jury, which has to employ the everyday meaning of the word. The Third Circuit Court of Appeals, which encompasses the federal courts in New Jersey, has approved a definition of the term, and that definition is whether the amount is substantial. That turns on whether, under the surrounding circumstances, the amount of the deficiency would be significant to an ordinary person. And as you can tell, what does significant to an ordinary person mean? What is significant to one person might not be significant to another. So this isn't a very useful definition. If substantial means more than noticeable, we're probably talking somewhere around 15 or 20% in additional taxes that are unreported. In an analysis borrowed from criminal conspiracy laws, the government has to first prove that the taxpayer formulated an intention or scheme to evade the tax, and second, that the taxpayer committed at least one overt act in furtherance of that scheme. The phrase overt act in furtherance of the scheme is a very common phrase that's used in connection with the affirmative attempt to evade tax. And overt simply means an act that is taken affirmatively in furtherance of some type of nefarious or illicit scheme. Willfulness is an elusive term. The definition is very precise: an intentional violation of a known legal duty. However, every word that you see in that definition has a specific meaning, from intentional to violation to known to duty. And that is the definition that the courts use, and that is the burden that the state, or the government rather, has to prove in any crime that they bring, or any charge that they bring against someone for tax evasion. This is the definition of willfulness. So while it's easy to define, it's not easy to apply. Courts have often compared willfulness to that of a chameleon, which changes in tone and color according to the Internal Revenue Code section involved and the circumstances. Now, what I want to do is just back up for a second, because an intentional violation of a known legal duty is a mental state that the government has to prove. And usually when this phrase is brought up, there's this other theory that is brought up in a companion respect, and that is called willful blindness. So under willful blindness, basically willfulness it can be proven by the government showing that the defendant made a conscious effort to avoid learning about reporting and record-keeping requirements. Essentially, that the person dug their head in the sand like an ostrich and remained deliberately ignorant, notwithstanding the fact that they knew that there were some requirements out there and that those requirements in fact applied to them. So willful blindness, being that a mental state is considered to be a cornerstone of proving any criminal crime, it's frowned upon by most circuits to allow the government to do an end run around this heightened standard of intentional violation of a known legal duty and use the watered-down standard of willful blindness to prove willfulness. So most courts will force the government to prove that the defendant intentionally violated a known legal duty in order to prove the element of willfulness. Nonetheless, willful blindness is sometimes allowed in certain circuits, and an example in the context of failing to file an FBAR would be that the defendant failed to learn of the filing requirements, coupled with other factors like efforts taken to conceal the existence of the accounts and the amounts involved. That may lead to a conclusion that the violation was due to willful blindness. However, for those of you who follow FBAR reporting closely, the mere fact that a person checked the wrong box off when asked on the 1040 Schedule B, Part 3, whether he or she had a foreign bank account, and box off no, that is not sufficient in and of itself to establish that there was an FBAR violation due to willful blindness. So without going off on more of a tangent of that, I just wanted to give you some background information as to an alternative by which the government sometimes tries to prove the willfulness element. It's a way of bootstrapping it in with an easier standard. In civil cases, the burden of proof is on the taxpayer, and that's in civil cases. In the criminal realm, the government always bears the burden of proof on every element of the offense, and that standard is proof beyond a reasonable doubt. That goes all the way back to time immemorial when we adopted our criminal justice system from English common law. We are very sensitive in this country of the presumption of innocence and allowing the person to come into court and stand innocent until proven guilty. And that guilt must be proved by the prosecutor beyond a reasonable doubt. What does that term mean? Well, a doubt based upon reason and common sense after careful and impartial consideration of all the evidence. It's proof of such a convincing character that jurors would be willing to rely upon it without hesitation in the most important of their own affairs. So again, this goes to how sacrosanct this beyond a reasonable doubt meaning is, and how difficult it is for the government to sustain its burden. And again, this is derived from English common law, and the facts and the factors and the fact is that the government, fears incarcerating somebody who is otherwise innocent. That's why there are such strong constitutional safeguards for liberty. The Third Circuit has a definition for reasonable doubt. A reasonable doubt is not a whim. It's not a speculation or suspicion. It's not an excuse to avoid the performance of an unpleasant duty. And at the same time, it is not sympathy. There are two aspects of the burden of proof. The first is the risk of non-persuasion, which we refer to as the burden of persuasion, or burden of production. So it's important to distinguish between the two, as this distinction does impact the outcome of cases. The risk of non-persuasion never shifts. And so I'm going to get into right now the shifting of burdens. And when I mean the shifting of burdens, what I'm referring to specifically is how a burden shifts from the prosecution to the defendant, or the prosecution to the taxpayer defendant, to be more specific. The risk of non-persuasion starts out on the government and it remains on the government. The burden of production, on the other hand, can shift depending on the particular issues in the case, and we'll get into an example of that. The overall burden of persuasion never moves away from the government, but the burden of production sometimes shifts. Initially, at the outset of a case, the government goes first. So the government's case in chief is always goes before the defense's case. And during the government's case in chief, it has the burden of production as well, because there has to be sufficient evidence to convince a reasonable juror that the defendant is guilty. Otherwise, the defense attorney at the end of the government's case in chief will stand up and ask for a dismissal on the basis that the government did not prove each and every element of each offense that was charged beyond a reasonable doubt. And that's actually standard for a defense attorney to make that argument, even if the evidence of guilt up to that point is overwhelming. Now, this shifting of burden occurs in income reconstruction cases. In fact, as a criminal defense attorney who practices a number of different areas of criminal law, I can tell you that the shifting burden of production occurs more in tax-related cases than in any other type of criminal cases that I see. Here's a quick and dirty example to illustrate the shifting burden of production. We're in a 7201 evasion of assessment case. That's simply the statute for tax evasion. The government shows that Adam, the defendant, omitted $100,000 of taxable receipts from his 1040. The issue here is whether this proves beyond a reasonable doubt that Adam owed tax on an additional $100,000 of income and thus is guilty of tax evasion. So, to be more specific, does the mere fact that Adam omitted $100,000 of taxable receipts lead to the inescapable conclusion that Adam owed tax on that $100,000 of income and that he's guilty of tax evasion? By itself, it's insufficient to prove that there was additional tax due and owing. So the mere fact that there was $100,000 of taxable receipts that were not reported on the return is not sufficient alone to prove that there was a tax deficiency. Why? It's theoretically possible that Adam had unreported deductible expenses that either completely offset the omitted income or offset it enough that the resulting tax was no longer material and therefore was insufficient to sustain a tax evasion charge. So it's interesting here. Keep in mind that we are in the criminal realm. We're not in the civil realm right now. And keep in mind the policy goals here of protecting the innocence of a person who, if found guilty, could be deprived of their most cherished liberty, which is their freedom. So what we do here is, it's almost engaging in any possible theoretically possible ways that the unreported income might have been offset. And so because it's possible that Adam had unreported deductible expenses that either completely offset the omitted income or offset it enough that the tax was no longer material, it would not be enough, the fact that there was $100,000 of unreported receipts to sustain this tax evasion charge. And what's interesting here also, if you're paying attention to this word material, it could very well be that Adam had unreported deductible expenses that at the end of the day still did not completely offset the $100,000 of receipts. However, the deductible expenses might have been enough to offset the gross income enough so that it was not material enough for the government to pursue a tax evasion charge, meaning the tax deficiency was not substantial enough to sustain a tax evasion charge. So if you remember from what we were discussing before, the government has to prove that there was a significant tax deficiency or sufficient tax deficiency. And if it's under a certain threshold, the tax liability that is under a certain threshold, then that might not rise to the level of material for the government to expend its scarce resources on charging Adam with tax evasion. So again, the unreported deductible expenses don't have to completely offset the $100,000 of gross receipts. It could partially offset the $100,000 of gross receipts, and at the end of the day, cause the resulting tax deficiency to fall below the threshold that would otherwise be necessary for the government to sustain a tax evasion charge. So the rule here is that the mere proof of unreported income is insufficient alone to establish additional tax liability. Now, what if Adam remains silent and doesn't suggest additional deductions or credits? Does the government have to go out of its way and investigate every possible deduction? Of course not. The Internal Revenue Code contains hundreds of deductions and credits, and one could only imagine the headache that would cause and the amount of work that would cause the government to have to painstakingly go through every single deduction and rule every single one out. Instead, what has to happen here is that Adam has to be proactive, and he has to be the one to point to the deductions. So the government doesn't have to say, we investigated whether there's a child credit. There's no child credit available here. We investigated whether Adam had more medical and dental deductions than were claimed on the return, but there were none. And we looked at Adam's business and didn't find any accelerated depreciation deductions under 168. And so the government doesn't have to negate every possible deduction or credit. It's not part of their burden of production to negate every deduction. Instead, the dance here is one where the government shows that there is unreported income. The burden then shifts to Adam to identify additional offsetting deductions. So Adam, as the defendant, must indicate at least some basis. If he asserts that he has offsetting deductions, he has to be able to indicate at least some basis for believing that these deductions exist. He can't just arbitrarily say, government, I have deductions that offset the $100,000 of gross receipts. He can't do that without having some evidence to back that up. Assuming Adam can produce evidence that he had expenses and deductions which reduced the tax to the point that it was no longer substantial, the government's case must fail unless the government can rebut Adam's version of events. Now, assume that Adam has some basis for believing that additional offsetting deductions exist. In that case, the burden then goes back to the government to negate the asserted additional deductions. So what we're saying here is that the government does not have to, at the outset, negate every possible deduction that exists in the Internal Revenue Code at the very outset. They don't have to do that. It's only when Adam injects this issue into the case that he has offsetting deductions that the burden then shifts back to the government, and the government is then obliged to negate the additional deductions that Adam has injected into his case to defend and to reduce the tax deficiency. And then ultimately, it's up to the jury to decide who made the more convincing argument. So the summary here is that the risk of non-persuasion starts out on the government and ends on the government. The burden of going forward starts on the government. It could shift to the defendant, and then it may shift back to the prosecution. Again, if it turns into a situation where the defendant raises deductions. Theoretically, there could be further shifts. Now we're going to get into direct, indirect, and hybrid methods of proof. This section addresses the means or theories by which the government attempts to prove the tax due and owing element of Section 7201. These methods can be used either during the government's case in chief or at sentencing, and there's a distinction that has to be made between whether they're used during the government's case in chief or at sentencing. When we talk about the government's case in chief, that's the trial itself, where the jury is, hearing the evidence, and they are the trier of fact, meaning that they determine what the facts are in the case. And the sentencing phase is if the defendant is found guilty, meaning the jury returns a unanimous verdict of guilt on the evasion charge, the case then would proceed to the sentencing phase. And the reason why there's an important distinction that has to be made here is because when it comes to working up the amount of tax loss, the amount of tax loss for purposes of proving one of the elements of tax evasion is different than the amount of tax loss that results in the potential amount of time that the defendant has to serve in prison if convicted. And so I'm going to get into that in more detail in a second. I apologize if that's hazy. But under the sentencing guidelines, the most important consideration is the amount of tax loss. The amount is what drives the defendant's time, so to speak, behind bars. It affects the sentencing guidelines and could be the difference between whether the defendant is actually, on home monitoring, on probation for a certain period of time, or whether the defendant is sentenced to a year or more of prison. The amount is what drives, the amount of the tax loss is what drives the punishment. So the larger the tax loss, the greater the period of incarceration for the convicted defendant. As unsettling as it might be, the government can attempt to prove for sentencing purposes a larger amount of tax liability than it attempted to prove at the guilt or innocence stage. And that's because the threshold for proving tax owing and due for tax evasion is less than what is required at the punishment phase or at the sentencing phase for the sentence. So the government could actually prove a lesser number for tax due and owing at the trial, and then inflate that number at the sentencing phase in order to try to extract more time from the defendant in terms of more jail time. Prosecutors can use a direct method to either establish unreported income or, in a few other cases, refute the taxpayer's claims regarding expenses and deductions. So these are the scenarios. In scenario number one, the government asserts it's right here. We can point to exactly what the problem is on this return. This deduction was claimed at $40,000, but it is legitimately only a $5,000 item. We can prove that the defendant overstated his deductions by $35,000. So it's as clear as day. It's binary. It's black and white. It's right here. The smoking gun is the return itself. In scenario number two, the taxpayer gets $75,000 worth of receipts from person A. These receipts were taxable, but the taxpayer never reported them on its tax return. The IRS's argument, we can identify precisely where it is on the false return and how it gave rise to the additional tax liability due and owing. Typically, in a direct method case, the government compares the claimed or reported amount on the tax return to the actual receipt, and ipso facto, it effectively meets both the burden of production and the burden of persuasion, because it's impossible for a defendant to explain away direct proof of this type. So it's like a stare and compare. On the right side of the desk, the IRS has the receipts. On the left side of their conference table, they have the 1040, and they're literally comparing one to another. And to the extent that the receipts don't match the amount of reportable income on the return, again, ipso facto or abracadabra, that's the evidence in black and white that the taxpayer underreported his income. In other cases, these receipts can fill in the blanks in an allegedly fraudulent return case. So the direct method, as is very obvious, is one that the government greatly prefers to indirect methods. Indirect methods is where the government doesn't have the smoking gun. It doesn't have the black and white proof that we just talked about before. They have to use other ways to prove that the taxpayer underreported income or overstated deductions. Direct method always starts with the taxpayer's return. When the taxpayer has filed a return for the year in question, the government will introduce it. In doing so, the IRS will use the taxpayer's admitted income as a baseline. And for hearsay purposes, the return is deemed the taxpayer's admission as to the items included on the return, so it's admissible. You may be familiar from having seen episodes of Law and Order where defense attorney jumps up and makes an objection on the grounds of hearsay, arguing that the document cannot be introduced because it has not been authenticated, and that the document has to be authenticated by a third-party witness in order to be introduced into evidence. And the idea there is that the attorney doesn't have the right to cross-examine the person who otherwise completed that item of evidence, and so its legitimacy or authenticity could be in dispute because it could have been manufactured by a nefarious prosecutor. And so the law always prefers that a person be introduced as a witness, preferably the person who constructed the document or who wrote the document, that person be brought into court and testify that he or she wrote it up, or that someone from the company or the business comes in to vouch for the document by stating that it is something that the company routinely produces in the normal course of its conduct and business. But when it comes to a tax return, that gets admitted into evidence without the need for an IRS revenue agent coming in to authenticate it. So let's say, for example, the return reflects $40,000 of gross income. The government can treat that amount as a given. Again, that's the baseline. The defendant may later state, oops, I was wrong. I didn't have $40,000, only $30,000. But think about it. That's going to be a tough road to hoe because taxpayers typically don't overstate their income on returns. And so that's going to be an uphill battle for the taxpayer to try to defend against the number that is in black and white staring the jury in the face on the tax return. Example number 2, if the taxpayer wants to dispute additional unreported income by asserting additional deductions, the fact that these additional deductions weren't on the return constitutes an admission that there weren't any additional deductions. So here's the situation. Here's how it sets up. The 1040 has been introduced into evidence, and the taxpayer is now arguing that there was additional unreported income. The taxpayer is arguing rather that there was additional deductions to offset the additional unreported income. But if the tax return doesn't reflect the additional deductions, then that in itself is an admission. The absence of those deductions constitutes an admission that there weren't any additional deductions. Criminal numbers, sentencing numbers, and civil numbers. So these three numbers diverge, and I was talking a little bit about that at the beginning, and now we're going to drill down and go into a little bit more detail on this. The government is very conservative when it comes to proving the tax deficiency at the trial phase or in their case in chief. The reason being is because if they try to prove an aggressive number, meaning a higher figure, and the jury finds that there is not evidence beyond a reasonable doubt to corroborate or confirm that number, then the whole case could fall by the wayside. And so that's why the government prefers to be conservative at the trial stage in their case in chief when it comes to the burden of proving the tax deficiency for purposes of proving tax evasion. So it's not unusual for the government to use different amounts of tax loss during the guilt and innocent phase and the sentencing phase. As I said, the tax loss at the sentencing phase drives the sentence. And so the greater the tax loss, the more punitive the sentence that the judge could mete out to the defendant. And so while it seems unfair that the government might be able to get a conviction for tax evasion with a lower tax loss number and then come into court at sentencing and heighten that or inflate the tax loss number to twice or three times what it was at the trial, it's still fair game, and this is still allowable under the law. So at trial, there might be more unreported income than what the government asserts in the guilt or innocence phase of the trial. For example, the government might believe that there's $110,000 of unreported income, but $30,000 could go either way. In other words, the government, in sizing up their case, realizes that while its tax loss number is $110,000, it believes that it might not be able to prove beyond a reasonable doubt to a jury that $110,000 was the tax loss number, but it believes beyond a reasonable doubt that it can show $80,000 of unreported income, and and so that $30,000 is a bit doubtful because it doesn't think that it can prove that beyond a reasonable doubt. So very simply, there may not be enough evidence to prove evasion of $30,000. In that case, the government will only assert $80,000 during the guilt or innocent phase. The government typically introduces rock-solid, hard, unshakable evidence in the guilt or innocence stage. Why? Because if there is a rumbling or a shaking, this tends to inject reasonable doubt. For this reason, the government selects a smaller number at the guilt or innocence stage. At the sentencing stage, the government's going to go all out, and they're going to, by going all out, what I mean here is that they're going to assert a tax loss of $130,000, unreported income of $130,000 or $120,000, going back to the example. $110,000 going back to this example of unreported income, because the tax loss on $110,000 is going to be greater than the tax loss on the $80,000. So they will go all out in asserting the full amount of unreported income at the sentencing phase. And on the civil side, the government seeks the maximum, because the standard of proof in a civil case is by a preponderance of the evidence. So to return to the earlier example involving Adam, the service might only establish $75,000 in unreported income during guilt or innocence, because the evidence regarding the other $25,000 is a little shaky. Later, at the penalty phase, prosecutors can use a $100,000 amount to maximize the criminal penalties against our poor friend. In all criminal cases, if there's no smoking gun, and by smoking gun I refer to direct method, where it's as clear as day, black and white, the 1040 reflects one amount, and the receipts reflect another amount, which is which is greater than the amount that was stated on the 1040. So in indirect method cases, the prosecutor has to rely on circumstantial evidence. It may argue that there is circumstantial evidence which logically leads to the inescapable conclusion that the taxpayer's return is wrong, even though the government can't point exactly to an item on the return that exhibits that. And this is subject to a heightened scrutiny for reasons that you probably have already guessed. Indirect methods are complicated and difficult to explain to juries. Jurors aren't accountants. They're not tax professionals. They don't have the same training and background in this area that we do. And so because of their potential for mischief, appellate courts closely scrutinize indirect methods. And so it's not, it's by no surprise that reversal on appeal is usually higher on indirect method cases than it is for direct method cases. So for indirect methods, there is a multi-step process. The government has to show the following. First, a direct method is not available or is unreliable. And so this is basically the threshold requirements that the government has to satisfy the judge of before it can pursue an indirect method of proof. And by not available or unreliable, those are two legal terms of art that I'm going to give you a definition for. Not available means that the taxpayer's books and records are unavailable, and that could be attributable to the taxpayer never keeping any records in the first place or having lost or destroyed them. And by the way, when we get into destruction of evidence, then we get into another crime in and of itself, which is called tampering with evidence or obstruction of the administration of the law, depending on whether you're in state or federal court. Unreliable means that the taxpayer's books and records are available, meaning that they were kept and they aren't lost, but in fact are right there, staring the government in the face, but they're not reliable. They contain errors galore. This barrier prevents prosecutors from ignoring hard evidence that may not be as damning in favor of circumstantial evidence that artful lawyers can doctor up. So what I mean to suggest here is that there is the potential, no matter how small, that the government might have a direct evidence case, but because the direct evidence is not as damning as a circumstantial evidence is, that the government may try to circumvent or get around the requirement of having to present a direct evidence case and go directly to an indirect evidence case, because they feel that the circumstantial evidence supporting their indirect evidence case far outweighs the evidence that they can present in their direct case. And this is the exact mischief that the court wants to prevent, and that's why they require the government to show that there was no direct method available. Second requirement, in order for the government to be able to use an indirect method, is that there's a likely taxable source for the unreported income. The government must show some source from which the taxpayer was likely to have gotten the unreported income. For example, in the hypo that we discussed earlier, Adam may have reported $100,000 of income from a consulting company in 2015 and Zippo in 2016. So it would, the fact that he had reported income from this consulting company in 1 year, and then a year later he now has zero income from that same consulting company, might be enough, or would be enough, to show a likely taxable source for the unreported income. If the judge determines that the prosecutor met both elements of the preliminary test and can use indirect evidence, there are 5 approved models. So let me back up for a second. If the government has satisfied the judge of those 2 threshold core requirements, then the judge will allow the government to use indirect evidence. The next issue becomes one of which model is the government going to use. And there are 5 approved models for using indirect evidence, and we're going to go through each of them. These are the types of indirect methods. The first is the net worth method. The second is the expenditures method. The third is the bank deposits and cash expenditures method. The fourth is a percentage markup method. And the fifth is the indirect methods to prove overstated deductions. So beginning with the net worth method, this method attempts to demonstrate that the taxpayer had more taxable income than what was reported. Now keep in mind that this is an indirect method, so we're not dealing with a smoking gun as we were with a direct method, as as in the example of there's $40,000 reported on the tax return, and there's $60,000 in receipts that are that we have staring us in the face on our in our evidence vault. We're in the realm of the indirect method, and so these are attempts under the net worth method to demonstrate that the taxpayer had more taxable income than what was reported. How might the government prove that without having their smoking gun? Well, they might show that the taxpayer had an increase in his net worth, an increase that could only have come from taxable income. So the government establishes its case through the net worth method in the following steps. First, it establishes the defendant's opening net worth using cost basis. Typically, these are multiple tax years. The government shows at the beginning of the first prosecution year the defendant's net worth. Net worth is calculated for non-cash assets at cost basis, not fair market value. If the taxpayer's asset appreciates in value before a realizable event, like the sale of the assets, the taxpayer does not have income. An unrealized appreciation is not taxable income. the government shows increases in net worth at the end of each of the years for the prosecution period. The government subtracts any known non-taxable receipts, the increase in net worth, and any acquisition of new assets may have been financed by income that wasn't taxable. The government must prove willfulness directly or by inference. The reasons why the government prefers to use a direct method over the net worth method, well, again, appellate courts are suspicious of indirect methods and will allow their use only if the government has no other recourse and only if the method is strictly applied. Second, there aren't as many IRS agents who are skillful in applying the indirect methods. As you can see from the brief overview of the steps required for the net worth method, it's highly technical and it requires very specific training for the agents to undergo. And again, we're in the criminal realm where every minute detail is put underneath a microscope and hyper-examined at trial. What are some common defenses to net worth cases? One such defense is that the net worth increase shown by the government is not an increase at all because of the existence of substantial cash on hand at the starting point. A second defense is that the net worth increase is attributable to a non-taxable source. The third is by attacking the accuracy of the government's opening or closing net worth figure. So if we break each one of these down, each of these defenses down, we'll start with the first one, where the net worth increase is shown by the government is not an increase at all because of the existence of substantial cash on hand at the starting point. And again, just so you understand what point of view we're taking here, we're taking the point of view of the defense attorney who's defending the person charged with tax evasion and where the government is proving the tax loss through the net worth method. So the net worth increase, this is the argument that the defense attorney is making, is not an increase at all because of the existence of substantial cash on hand at the starting point. The defendant typically has to testify in these cases, and this is paraphrasing what the testimony has to be like. I had a cash hoard which I had built up over the pre-prosecution years and which I didn't spend until the prosecution period. That's what supports the increase in my net worth. I used the money from the cash hoard to buy these additional assets, not from unreported taxable income. So breaking this all down, what we're really saying is that, or what the defendant is really saying is that I had cash on hand that I was storing underneath my mattress or at home in a safe and secure place. I didn't spend it at the time that I earned it. Instead, I held on to it, and it wasn't until the years of the prosecution period that I started spending that money on various objects or pieces of property or fancy schmancy items. And so that's why, that's what supports the increase in my net worth in terms of the property that I became owner of during the prosecution period. So cash hoards are usually, the defense usually argues that this was money lying underneath the taxpayer's mattress that was being saved to be used on a rainy day in the future. Sometimes, as in some cases, they were actually stored. The cash was stored in a PVC pipe in the backyard of the person's home. What are the potential sources of a cash hoard? Non-taxable sources or taxable sources in years as to which the statute of limitations has already expired. And so you can already guess that the defense is going to have a long road to hoe in order to explain how, $20,000, $30,000, $40,000, $50,000 or greater was attributable to a non-taxable source and was essentially cash lying on hand, in the taxpayer's home. Typically these cases are cases where the taxpayer owns a cash-rich company. And what I'm talking about is, a store, a cleaners, a pizzeria, a bagel store, any business where cash is typically received in exchange for, food or for other products. That usually lends itself to the taxpayer, withholding that and not reporting it on their tax return. And so to the extent that the taxpayer, runs a cash-rich business, the IRS is typically going to argue that there was a taxable source for that income, and it was, in fact, the taxpayer's business, the taxpayer's pizzeria or the taxpayer's bagel store or any one of a number of the taxpayer's tax-rich businesses that generated that income. And so it should have otherwise been reported on the return. How does the government rebut the cash hoard defense? It has to prove a negative that there was no cash hoard. So it uses admissions made by the taxpayer. It uses financial statements given by the taxpayer to federal or state agencies. And it's for that reason that the taxpayer is always advised not to speak to any IRS agents at any time, even before the case has turned criminal. And that's because the statements that are made by the taxpayer, even in the course of a civil investigation, can sometimes come home to roost and to be used against him or her later on in the criminal stage. And there are all sorts of rules that govern the giving of statements and the taking of statements and whether they are admissible later on against the taxpayer in the criminal stage. But more or less, any statements that are given during the civil stage where it's not leaning towards a criminal referral can later on be used against the taxpayer at the criminal stage of the investigation and at trial. So you want to be very careful and caution your client from making any statements whatsoever to any government agent. Reconstructing taxpayers' income from pre-prosecution years using tax returns and other information to show low amounts of prior income. Again, these are all the ways that the government uses to rebut the cash hoard defense. If there isn't a lot of income listed on prior year returns, the government can legitimately ask, where did the money come from? Maybe the answer is non-taxable sources, but now what we're doing is we're basically chasing our tail around in circles because we're making a circuitous argument. We can't say, the taxpayer can't defend that the source of this cash hoard was a non-taxable source because it was a non-taxable source. If the government asks where did the money come from, that's a legitimate question that the taxpayer has to answer. The taxpayer can't stand up in court and say it's a non-taxable source because it's a non-taxable source. The taxpayer has to give some rational explanation for the source. And where the taxpayer gets into trouble here is when the taxpayer has, perhaps $100,000 or more of cash that was in that PVC pipe or that was stored in the mattress underneath his bed, and where the amount of gross income reported in that year was only $100,000 or was only $80,000. There's going to be that's going to gut any reasonable doubt that the jury may have in their mind that that money, that cash hoard, came from a non-taxable source. The disparity in the amount of the cash hoard that was found in the mattress versus what was reported on the return. So sometimes you have to be careful because you could be digging yourself a hole by arguing that this cash hoard was attributable to a non-taxable source if the amount on the return reflects a staggeringly less number of in gross income than what was found in the mattress or found in the PVC pipe. Or the money, might have been left to the taxpayer from a relative who died. So I don't want to, leave you with the impression that there is never going to be a non-taxable source. To the extent that the taxpayer inherited the money from Aunt so-and-so or Uncle so-and-so, that could be a legitimate non-taxable source and an explanation for the source of the money. These days, however, the very existence of a large sum of cash on hand in the home, leads to this, leads to the speculation that the money, was being hidden and was being, was being hidden, and that the taxpayer didn't want to report it as gross income because he or she didn't want to pay taxes on it. And then this is another way that the government guts the defendant's cash hoard defense by establishing a history that casts doubt on the idea that the taxpayer had cash lying around. And the government might rely on the taxpayer filing bankruptcy or borrowing money so they can catch the defendant in a white lie. For example, if the taxpayer has been borrowing money from a friend or from a third party or filed bankruptcy, the government will turn around and say, wait a second, defendant, you just said that you're claiming that you had $100,000 on hand in your home. Why, pray tell, did you have to file bankruptcy, or why, pray tell, did you have to borrow, this amount of money if you had this cash lying around and it was readily available to pay your bills? Why did you have to go to Aunt, Lucy or Uncle Sam to request a loan? So, example, does the taxpayer have significant balances on his credit cards? If so, why? And these are all the questions the government's going to ask. If the taxpayer had cash lying around, why did he use it to pay off the credit cards to avoid the 22% interest rate? Nowadays, of course, the interest rate isn't quite that high, but we still see the interest rate, around 15 to 18%. So it's a legitimate question, and it's a question that defense counsel and the defendant is going to have to answer to the satisfaction of the jury. With cash on hand, why the heck wouldn't the defendant have paid his credit cards down when they're accumulating interest at such a high rate? And another example, why did the taxpayer have to file bankruptcy if he had all the cash lying around? Why did the taxpayer have to borrow money from Uncle Fred or Aunt Lucy if he had all the cash lying around? Why were you living below the poverty level? Or why did you file a low-income housing application? As outrageous as some of these sound, trust me when I tell you that these questions come up time and time again, and they oftentimes, catch the defendant by surprise on the stand when he's giving testimony. And these questions, in and of themselves, can sink the defendant's ship, or at least gut the defendant's cash hoard defense at trial, and basically be the smoking gun that leads to conviction. Another way that the government might rebut is that the net worth increase is attributable to some non-taxable source. Another way the defendant might defend these cases is on the grounds that the increase is attributable to non-taxable source. We just talked about some legitimate non-taxable sources. These take the form of gifts, inheritances, and loans, and that might account for the newly acquired wealth. These items are non-taxable. And so an example might be my aunt died and left me with $100,000. My brother gave me $10,000. I got a loan. Government has no burden to negate this defense until the taxpayer puts it into play. So it's kind of like what we talked about earlier, where the government doesn't have to negate every possible deduction that exists in the Internal Revenue Code. It's only if the taxpayer asserts one of those deductions, then the government is left to having to negate it. How much detail must the defense give the government, and when? The defense has to give the government this information with sufficient and adequate specificity and with sufficient timeliness. They can't spring it on the government in the 11th hour before trial. If the defense fails to do either, then the government is relieved of its obligation to negate the item. An example, the IRS investigation shows that the taxpayer had an opening year net worth of $50,000. The taxpayer had a checking account with $50,000, which was the only asset the IRS could locate. The net worth method conclusively proves that the taxpayer had $57,000 of unreported income in the 2-year period. Taxpayer's argument: the method is flawed because I had an opening net worth in the form of an inheritance that the IRS didn't identify or verify. We're adding some more facts here. 1 month before the opening date of the 2-year period, the taxpayer receives a $50,000 inheritance that is non-taxable. He goes to Las Vegas, cashes it there, loses it all within days. Had taxpayer retained the $50,000 past day 1 of the 2-year period, it might have accounted for enough of the indicated income that the government would not have pursued an evasion case on the $7,000 that remained. But because the cash had been spent prior to day 1 of the 2-year period, the net worth method correctly indicates that the taxpayer had $57,000 reported income. So these are all different fictitious circumstances, but they nonetheless could be possibilities that relate to the inheritance being non-taxable. Assume that the IRS could not exclude the possibility that the taxpayer held all of the cash on that critical opening date. Can the taxpayer's attorney affirmatively advise the IRS that the inheritance accounts for $50,000 otherwise unaccounted for cash on the opening date? Well, before we even get to that issue, the relevance of it is that it eliminates the net worth method as a means to obtain a conviction. And so returning to the question of whether the taxpayer's attorney can affirmatively advise the IRS that the inheritance accounts for $50,000 of otherwise unaccounted for cash on the opening date, the answer is that the defense can't say to the government, your figures are wrong because you didn't include this $50,000 inheritance. That's because misrepresenting a known false fact violates Section 1001. But the attorney could ask IRS special agent if he considered the inheritance only 1 month before. It's merely a suggestion and not a misstatement of fact. By asking the question, the attorney is merely implying that the money might account for some significant part of otherwise indicated unreported income. So again, the defendant cannot affirmatively state to the government your figures are dead wrong because you didn't include the 50 inheritance, and the reason is because it is a falsehood. It's a misrepresentation of false fact. But the suggestion can be made by the attorney to special agent about whether he considered the inheritance only 1 month before.
And by asking the question, it's merely implying that the money might account for some significant part of the indicated unreported income. It's not a statement of falsity. It's not a false statement. Is this implication sufficiently close to a statement that it puts defense counsel in an ethical quandary or an ethical 1001 problem? Well, the rationale here is that the defense has the right at trial to challenge the method and challenge the method aggressively used by the government to identify opening net worth. So the defense counsel should be able to ask the agent whether a significant item that should have been considered but wasn't, whether that item could impact the government's application of the net worth methodology. So the courts are so cynical or so reluctant to give complete credence to the opening net worth method or to the net worth method that they're willing to allow the defense to put into issue the suggestion that a significant item that should have been considered wasn't considered, and that's essentially the rationale behind why the defense has the right to challenge the method by inference as to whether this item should have been considered, but by the government when it began to work up the net worth method. Attacking the accuracy of the government's opening or closing net worth figure. This argument is just a straight up, you crunch the numbers wrong. An example is the opening net worth that I had, and this is what the defense is asserting. The opening net worth that I had was greater than you thought it was. Therefore, the difference between opening and closing net worth was less. Or defense counsel is arguing the closing net worth was less than what the government thought it was. And so there are a number of pitfalls inherent in the net worth method, and we're going to close on this point. While the government might be able to prove with reasonable accuracy an increase in net worth over a period of years, it often has great difficulty in relating that income sufficiently to any specific prosecution year. That's why the government rarely, if ever, brings a single year indirect method case. So in recognizing the inaccuracies and pitfalls of the net worth method, what should courts do? They approach these cases with the realization that these imprecise methods might ensnare innocent taxpayers in the coils of prosecution. So jury charges are crystal clear. They include a summary of the nature of the net worth method, the assumptions on which it rests, and inferences available both for and against the accused. These are the bare minimum constitutional safeguards that the courts put into play. The jury charges, are very specific in these cases, and again are designed to safeguard the constitutional rights of the defendant. And appellate courts should be particularly vigilant and are, when they get these cases on appeal, to make sure that the trial judge did their job correctly and that there wasn't an inappropriate conviction based on a faulty use of an indirect method. And we're going to end here. There are other indirect methods for proving, underreported income or overstated deductions. I went through a list with you earlier. We've spent a great deal of time on the net worth method, but as you can see here, there is an expenditures method, and there are a few other methods as well. Bank deposits and cash expenditures method is another recognized method that's used in indirect cases, and there's a percentage markup method that is used as well. And there's also a hybrid method, indirect methods to prove overstated deductions. And so you can review these at your leisure. if you have any questions whatsoever, I encourage you to reach out for me. As I said, in indirect method cases, these are scrutinized on appeal. And there's a hybrid method, which basically means that various indirect methods can be combined, and as long as it does not create confusion. But as you can see, that even one indirect method in and of itself can cause a great deal of confusion. So it stretches the imagination to think that multiple indirect methods won't create more confusion in the mind of the jury. So in closing here, anyone who's ever faced off against the IRS knows all too well that this agency has a number of tools to collect what it claims a taxpayer owes, and in an audit situation, these tools are powerful and intimidating. They're still present in criminal court, even if there is no direct evidence supporting an income tax evasion claim. Nonetheless, the harder the Department of Justice tax must work to obtain a conviction, the higher the likelihood of a positive outcome for the taxpayer. So if you have any questions at all, feel free to reach out for me at any time. As I mentioned at the outset, my door is always open. It was a pleasure presenting this, and I wish you the very best.